And what I did while I hope everybody was doing their homework is I created my own little business here as a way of walking people through the bottom line tool. And we were making cookies here last night. So here we have a new business, Christine's Cookie Shop, which is going to start in January of 2021. And what I'm going to do here is go through very briefly the blue tabs, which are our input tabs that we've been talking about this week. And then I'm going to spend more time going through the red tabs, which are the output pages, just so that as we finish up your projections, you have a good sense of how to look at the red pages, what to look for, and that sort of thing. So very briefly, as we discussed, our tab 1, sources and uses, I input a lot of the fixed assets, the operating capital, and the sources of funding for my bakery. I've included, $50,000 in leasehold and building improvements, $15,000 in equipment, some furniture and fixtures. Moving down to operating capital, I've had to prepay for certain things like rent, legal and accounting, some inventory, supplies, and some working capital. So my total required funds is $100,000, which I am going to provide by a $30,000 investment on behalf of my business and a $70,000 commercial loan. So my sources and uses will balance. What I am planning is to offer a combination of baked goods here. So you'll see, if you look on the top left, cookies at $2.50 each at a 75-cent cost, cupcakes, $3 each, 90-cent cost. I'm going to make cakes, sell drinks, coffee, and then offer parties. So slightly different cost structure on the parties. Now looking down, I've got, for each of my product lines, I've created a sort of a demand curve starting in January, 150 cookies for the month. So very simple, new business. People don't know about me. If I'm open 30 days, I think I'm going to sell 5 cookies a day, slightly more cupcakes. And then I assumed a percentage of the people coming in for cookies and cupcakes would buy drinks and coffee. And then I think I'm going to start with 2 parties a month and grow from there. And as we discussed, the model will calculate the total revenue and the margins. Now to do this, because I am a new business, I'm assuming I'm going to be mainly the one working. I'm not going to pay myself until I'm profitable, and I'll hire one part-time employee who works about 15 hours a week, and I pay $13. I'm planning that by the second year, I have enough to hire one full-time employee as well as my part-time person. I pay them a little more, and I grow from there. For the second and third year, I'm assuming a big sales bump in the second year of 20% and then 15% in the year after that. When I look at my overhead, these are the categories that we spoke about yesterday. I'm going to assume some advertising to launch, $500 a month. And then I'll taper that down for the spring and summer, and then I'll ramp that up again at the end of the year. I'm going to assume some insurance expenses for my location, some legal, professional, some licenses. I know I need my food license once a year, about $250. My bakery rental, $1,800 a month. I'm going to assume some repairs and maintenance, create a budget for that, $200 a month supplies, $150 a month for travel, meals, and then utilities of about $750. And most of those I've left as a level monthly expense. So those are just a quick walkthrough of all the blue pages, the input pages that we've talked about. Now, when you're done with that, what you'll see is the red pages, which aren't on your model, but I will share these once we're complete. And we come up with a 1-page income statement. And as we discussed, I think in our original session on Tuesday, what this is your profit and loss statement. It takes all of your revenue up front, subtracts the costs to give you what your net income is. For the first year, our model looks at it on a monthly basis because it's really important to look on a granular basis. And then the second and third year out, it annualizes that. So what you'll see if you go from the left, we've got revenue by each of the product lines, our costs by each of the product lines. It looks at payroll in aggregate, row 23, and then it takes each one of my expenses out. And what you'll see in line 41, it's EBITDA, earnings before interest, taxes, depreciation, and amortization. This is sort of a tool, you know, when I look at ability to borrow money, you kind of look at EBITDA as a mechanism for paying it back. So you can see I'm negative $3,000 in my first month, but then by the fourth month, I've pretty much broken even, which is a really nice fast ramp. If we look at the first year, and this is net of the loan repayments that I'll need to make, I do remain cash flow positive and profitable, and I have a small, you know, break even of 13,000 in profit by the end of the year. Now, granted, I didn't pay myself for all of this work, but this is sort of a nice little new business ramp. Now, moving over to the cash flow statement, this is what shows sort of inflows and outflows of cash, as we discussed. And you'll see I had in cell C7, the beginning balance in the bank is that $10,000 that I called working capital in my sources and uses. It's the amount of extra funding I left for my business to make it through, whether, you know, that initial ramp. And you can see that that $10,000 gets drawn down by the amount that my business is cash flow negative in that first month. And you'll see in when you go down to line 33, the ending cash balance is 5,000. So I really did need that. And if you follow this along on row 33, the ending cash balance, it gets more negative and more negative until I go positive again. And if I really look at this, I actually needed more than just that $10,000. So that's something we could fix in the next iteration. Finally, we have a cash flow for years 2 and 3 that we can look at in the summary. We then have a balance sheet, which is very simple. You can see I've got cash, I've got accounts receivable, got some inventory purchases, some prepaid expenses, and you'll see everything balances nicely. On tab 16, this is where you'll see a full P&L for the first, second, and third year. So this goes all the way down to the bottom, shows that we are, you know, break even in each of the 3 years. And what I did layer in and why the second year isn't as profitable as the first is I have a full-time employee or I'm paying myself. So that's where that goes. Now, some of the tools that I like to look at, we do have this break-even analysis, which is tab 18. And you can see, I think this is a very helpful tool. Once you've loaded in your expense structure, your payroll, this will spit out what your monthly goals should be. And you can use this as a way of, you know, sort of creating something to strive for, but also a sanity check. Like, does this seem reasonable to get to? Does the cost structure match the opportunity that, that we have in front of us? And what this says to me is, for my bake shop, am I able to make, you know, $8,570 on a monthly basis? Because that's what I'm going to need to break even. There are a couple of other tools that we use when we're looking for financing, and when we go to, if you were to go to a bank or look for an investor, this Diagnostic Tools page can be helpful because it looks at the model that we've created and compares it to other things out there in the world. If I'm looking for a bank loan, for instance, the banks will want to make sure that the owner has some cash invested, you know, some skin in the game, as they say. So in mine, I've got $30,000 I have put in, so 30%, and the model thinks that, yes, that is more than reasonable. It also sort of sanity checks my interest rates to make sure that that seems consistent with what's out there. And it also will do a little bit of an income statement reality check in terms of your gross margin as a percentage of sales and that sort of thing. So I think with that, you know, there are some more, you can look through and spend more time on the red pages. And that's certainly something that I am happy to walk through with you. But at this point, I think, Felicia, I'm going to stop this share.